Let's get to our next guest and investment strategies. I know pretty interesting at the moment with what's going on. Lots in the macro space in particular. David Sokulsky from Carrara Investment Management joins us here in our studio. David, welcome back to the program.
Thank you.
Yeah, it's been pretty interesting since we last spoke. Federal Reserve has stolen a lot of the headlines, as has the RBA and the jobs report here in Australia. What's on your radar?
Look, I think you just named it.
Yeah, there we go.
When you look at what's driving markets, really is central banks at the moment, and I think what we're seeing is a real shift in mentality now, where we've had central banks being very static for probably 18 months. Fiscal policy has driven a lot of the markets and a lot of the reactions around the world, and now we've got central banks back into play. So we're going from a sort of low volatility central bank environment to much more of a high volatility central bank environment where we really don't know what they're going to do. We presume they're going to hold the line and not raise rates for a while, but how long does a while mean? It seems like their targets they've previously set are not going to be maintained. The Fed's already fallen away from it. The market's fallen away from it in Australia. So they're going to hike rates before they thought they would. Just when, we don't know. And I thought Powell's comments overnight were, they were taking a sort of side each way, where he's saying, look, we don't think inflation's going to reach the 70s level. We don't think it's a problem. But at the same time, we're committed to price stability. So if you've got inflation at 3.5 to 4, which is sustainable, what does that mean? Does the Fed then start hiking rates as early as early next year or not? And that's where I think we just don't know at the moment, and that's going to create a lot of market volatility going forward.
Yeah, so uncertainty, the name of the game then. Equity markets, is it just that? We're just going to see movement, it's not going to be that trend line that we saw previously?
Yeah, look, I think we are going to see just movements around the current levels. There's so much liquidity still there that people aren't willing to add a lot of cash. They still want to have that equity market exposure, but no one that I speak to is really looking to add at these levels. They're just looking to maintain their exposure. And I think, going forward, it's probably more a case of how you allocate that risk. And, if we are going to see a Fed which is probably more aggressive than the market thinks it was going to be, we're going to see a stronger US dollar. So we're probably going to see a weaker Aussie and a weaker Euro, and that's going to benefit those equity markets. So to my mind, it's probably just a readjustment of where that risk capital is, rather than taking it completely off the table or anything like that.
Is it a time to go a little bit more defensive in the portfolio, whether it's buying protection or whether it's going to cash or more defensive parts of the equity market? What's your stance?
Yeah, look, I would think that now is a good time to be raising a bit of cash. And the thing is, if inflation is going to be transitory, but the market's going to react to the data points, then you are going to get buying opportunities. And you want to have the powder there to be able to take advantage of those opportunities. If you're fully invested at the moment, you're probably going to make emotional decisions which are incorrect, and you're not going to have the ability to take advantage of the sell downs when they come. I think, do you buy protection? It's a little bit of a question mark on where volatility is. If we're seeing volatility spike, as we're seeing right at the moment, that protection becomes expensive. You've got to buy protection at the right time, and the right time to buy protection is when you don't think you need protection, because then your prices are right. So at the moment, probably cash is the better option, I would think. But certainly if volatility settles down, this volatility overall in terms of uncertainty around central banks is not going away. And that's what we need to be prepared for.
So what sectors are you keeping the cash on the sidelines for? Where do you see the opportunity if that happens?
Yeah, look, we are still in a very good economic growth environment. So if you look at, say, the IMF numbers at 6% globally this year, 4.5% next year, generally that economic environment benefits those sort of mid-cap sectors. Now, to my mind, what we're seeing is we've seen a big large cap rally, particularly in Australia, and that's where we're going to see some of the sell downs come. So if we do see those mid-cap areas come down and they are still going to benefit from the economic pickup, that's, I think, where you want to be looking at the moment.
Look, don't want to put words in your mouth. When it comes to those places that you might go and take a bit of cash off the table, people are looking at the financials. The banks have had an exceptionally good run, lots of good news pricing, material space, commodity prices sitting basically at decade highs across lots of major commodity markets. Are they two areas where you're likely to go and see some of the money come out of into other parts of the market?
Yeah, look, you're welcome to put those words in my mouth, because that's exactly where.
There we go.
I think you've got China really trying to pressure the iron ore price down at the moment. Commodities have had a fantastic run, and particularly those big iron ore producers, the prices are elevated now, and they're probably elevated because they're also paying an excellent dividend. But certainly if we see an iron ore price come down to, say, 150 to 175, we're going to see prices decline there. So, that's certainly an area where, be looking to take some profits. The banks have benefited incredibly from effectively free money from the RBA. Now, that's all but done now, and the RBA is not going to be giving that out again. So, yeah, the drive for the big commercial banks to actually benefit from free money is coming a bit to an end. So they're still going to demand for home loans, and applications are still backlogged in terms of getting through the back office of the banks. But the margin that the banks can charge now and that they can earn is going to be shrinking, when that RBA deal goes away.
David, great to have you in. Thanks so much for joining us this morning.
Thank you.